Shall we now start, beta? Okay, fine. So now we'll be doing the last chapter, and that is your investment decision. Okay, last investment decision. Okay, so as you all are aware, is the company going to invest in different types of projects? Come on, yes or no? Yes, sir. But are you going to invest in all the types of projects? Then the answer is no. We will be carefully evaluating the projects, and we will evaluate the projects using various methods. Okay. So everyone, the first method on the basis of which the projects can be evaluated, that is by the way of your net present value method. Have you heard about this? NPV. Then the second method on the basis of which the projects can be evaluated will be your IRR, internal rate of return. The third method which we have for the purpose of evaluation will be your profitability index, which is also known as PI or also known as PV index. Then we have something which is called as your ARR, that is accounting rate of return, or also known as average rate of return. Then we have something which is called as payback period. And then we have something which is called as discounted payback period. Okay. Now, there is something which is also called as your modified internal rate of return, MIRR. Now, net present value. As you all know quickly, net present value is present value of cash inflows from which we subtract your present value of cash outflows. So, always remember that there are two main types of cash outflows. How many main types of cash outflows, beta? Two main types. The first one is called as your initial investment, and the second one is called as investment in working capital. So when we are making investment in fixed assets, etc., so along with that, what we have discussed, that we also have to invest in your working capital. So both these investments, when will it be made, beta? Will it be made tomorrow, day after tomorrow, or will it be made today itself? Today. So when it will be made today, can I say we have to multiply that by 1 to actually get what is the present value? Because today when the investments will be made, the present value will be always 1. So whenever we make investments at year 0, we have to multiply that by 1. When we talk about the cash inflows, what are the different types of cash inflows, guys? Can I say we have cash inflow from projects, cash inflow from salvage, and cash inflow from recovery of working capital. Okay. So always remember that salvage and recovery of working capital, when it will be received, beta, will it be received now or it will be received towards the end? Towards the end. So we have to multiply that by the discounting factor towards the end of the project. Okay. And guys, whenever we are talking about cash inflow from projects, then these cash inflow from projects, either it can be constant or it can be not constant. Now, if I tell you that let us invest in a project, okay, in which there is year 1, year 2, year 3, and the cash inflows are 1 lakh, 1 lakh, and 1 lakh. Then can I say every year the cash inflows are same? Come on, yes or no? Yes, sir. If I tell you that let us calculate the present value, how will you calculate the present value, beta? Can I say we have cash inflows every year same? Come on, yes or no? Yes, sir. So if I want to calculate the present value, can I say whatever is the discounting factor, I will take the present value annuity factor, and will I be getting the PV of CI? Come on, yes or no? Yes, sir. Okay. So apparently, let's say for example, the discounting factor is 10%. So 1 divided by 1.1 will give you 0.9091, 0.8264, 0.7513. Now, one of the option is you take 1 lakh multiplied by each and everything. But whenever the cash inflows are constant, you simply take the total of this discounting factors, which are known as what, beta? Annuity factor. And if I take this present value annuity factor and multiply that by cash inflow per annum, will I be getting the PV of CI? Come on, yes or no? Yes, sir. And whenever cash inflows are not constant, then definitely we have to prepare a table. Suppose this is 1 lakh, 1 lakh 50, this is 2 lakhs. Then can I say we have to prepare the table, then we'll be multiplying that by the PV factor, and then we'll be getting the present value of cash inflow. From the present value of cash inflows, what do we subtract, beta? Present value of cash outflows. Ultimately, what we will get, beta? NPV. NPV should be lower the better, or NPV should be higher the better? Higher the better. Okay, and if there is only one project, then we will select the project if the NPV is positive. Okay, so NPV is a very simple thing, discounted cash flow method, where what we have to do is we have to take into consideration whatever is year 1, 2, 3, whatever is the series of cash flows, we have to take that into consideration. We'll be discounting it and we'll be converting that into present value. Now, my dear students, you are also aware about the fact that there is something which is called as IRR, internal rate of return. What is internal rate of return, beta? Internal rate of return is that particular discounting factor at which your NPV is 0. What does it imply? It means that your PV of CI should be what? Equal to PV of CO. And how do you calculate your internal rate of return? To calculate the internal rate of return, what do we have to do? Then we have to use trial and error method. How do you calculate your internal rate of return method, beta? By use of what? Trial and error method. In trial and error method, what do you have to do? We will take one discounting factor. Suppose my PV of CO is 1 lakh. Okay. So then at IRR, your PV of CI should also be coming as what? 1 lakh. So what we will do is, first we will discount the cash inflows. Let's say, for example, there are 3 years of cash inflows of 1 lakh, 1 lakh 50, and let's say 80,000. We will discount it at, let's say, for example, 10% rate. And then we will realize that the PV of CI which is coming is, let's say, 1,30,000. Example. Please tell me that, is this PV of CI 1,30,000 greater than 1 lakh which you want? Come on, yes or no? Yes, sir. So basically this 10% discounting factor will not work. So now we have to reduce the PV of CI from 1,30,000 to 1 lakh. What do you think you have to do? Should you reduce the discounting factor or should you increase the discounting factor? Increase the discounting factor. Suppose I increase the discounting factor to, let's say, 20%. And by taking 20%, suppose this figure is coming as 80,000. Then can I say this 80,000 is less than 1 lakh? Come on, yes or no? Yes, sir. So have we created a range in which your 1 lakh rupees is falling? Come on, yes or no? Yes, sir. Can you all please tell me that 1 lakh rupees which is falling is between which two discounting factors, beta? 10% and 20%. Then we have to do interpolation for the purpose of calculation of IRR. How do you do the interpolation? Between 10 and 20%, what is the range, beta? 10% is the range. Come on here. And in 10% range, we have discounted from 1,30,000 to 80. So can I say we have discounted up to 50,000? But guys, we don't have to discount from 1,30,000 to 80. We want to go from 1,30,000 to how much, beta? 1 lakh. So how much further discounting needs to be done? 30,000. So for 30,000, how much percentage would you require? So approximately 6%. So can I say that your first discounting factor was 10% and now you have to add 6%. So can I say 16% is the IRR? Come on, yes or no? Yes, sir. So IRR is a discounting factor at which your PV of CI should be what? Equal to your PV of CO. Come on here. Are you all aware about this? Okay. Then beta, we have something which is called as your third method, which is profitability index. Now profitability index is an extended version of your NPV method. In NPV method, what we used to do, PV of CI minus PV of CO. In profitability index, what will you do, beta? PV of CI upon PV of CO, because it's an index. Index is a ratio. So you will take PV of CI upon PV of CO. You would always want this profitability index to be 1. It should be lower than 1 or it should be higher than 1. Aditya, it should always be higher than 1. PI should always be higher than 1. If PI is higher than 1, then what does it indicate, beta? Can I say PV of CI is what? Greater than your PV of CO. Okay. At IRR, profitability index should always be dash. At internal rate of return, your profitability index should always be dash. Answer is 1, not 0. Why? Because at IRR, your PV of CI and PV of CO is same. So when I take PV of CI upon PV of CO, which is same, then can I say that my profitability index is going to be dash, beta? It is going to be 1. Okay. Then what is ARR? Accounting or average rate of investment or return. So accounting or average rate of return. So here we have to take whatever is your average net profits after tax. We divide that by average investments into 100. If you want, you can also take average NPAT and divide that by original investment into 100. Any one of the two options. But the difference between ARR and all the other methods is the ARR considering profits in the numerator? Come on, yes or no? Yes, sir. And all the other methods takes into consideration your cash flows. So is there a difference between profits and the cash flows? Come on, yes or no? Yes, sir. What is the difference between profits and the cash flows? Can I say we have to adjust the amount of depreciation? So you all are aware about the fact that from sales you subtract variable costs, what do you get? Contribution. From that you subtract fixed costs, what do you get? Net profit before depreciation, interest and tax. From this if I subtract interest, then what do I get? Net profit before depreciation and tax. From this if you subtract depreciation, what do you get, beta? Net profit before tax. From this if you subtract tax, what do you get, beta? Net profits after tax. Then you have to add the depreciation to get the cash flow. Whether it is IRR method, payback period method, NPV method, profitability index method, we are always going to talk about cash in. But only for ARR method, we are going to talk about what? Net profits after tax. So it does not take into consideration the cash inflows. Okay. Also at the same time then, we have something which is called as payback period. What is payback period, beta? The time period in which whatever investments you make, you are going to recover that. That is called as payback period. Now let's say for example, I invest in a project worth rupees 10 lakhs and every year I am going to get 2 lakh rupees. So what is my payback period, beta? 5 years. In can I say 5 years I'll be recovering my entire 10 lakh rupees? Come on, yes or no? Yes, sir. But that is only possible when the cash inflows are constant. When the cash inflows are not constant, then suppose there is year 1, 2, 3, 4, 5 and the cash inflows are 1 lakh, 1 lakh 50, 50,000, 2 lakh and 5 lakhs. And my cash outflow is, let's say for example 4 lakh rupees. Then let us check that it is getting recovered at the end of which year. So my first question to you is, can I say the cash inflow is 1 lakh rupees here? Now can I say the cumulative cash inflows here will be what? 1 lakh. And this will now be what? 2 lakh 50. This will be what? 3 lakhs. This will be what? 5 lakhs. This will be what? 10 lakhs. Can you all please tell me this 4 lakhs is now recovered between which and which year, beta? Third and fourth year. Now can I say I can take same interpolation and calculate what should be the payback period? Come on, yes or no? Yes, sir. So that is possible in your payback period when the cash inflows are not constant. Also at the same time, then there is something which is called as discounted payback period. Can you tell me what is discounted payback period? In the discounted payback period, please tell me that will we consider cash inflows or we will consider present value of cash inflows? Of course, we will consider present value of the cash inflows. And then what are we going to do? Once we calculate present value of cash inflows, then we will take the cumulative cash inflows of those present value of cash inflows. And then we'll be getting whatever is the year in which your PV of CO is recovered, and that's how we'll be getting the answer. Everyone please tell me, your payback period should be higher the better or payback period should be lower the better? Of course, lower the better. Your discounted payback period, that should be higher the better or that should be lower the better? That should also be lower the better, because we always want the paybacks to be as fast as possible. Then there is something which is called as modified internal rate of return. Now in modified internal rate of return, there will always be a cost of capital or the reinvestment rate which will be given to you. So let's say for example, you have 4 years, year 1, year 2, year 3, year 4. And suppose your cash inflows are given to you as 1 lakh, 1,50,000, 50,000 and 70,000. Now in your modified IRR, you know what happens? That we are going to reinvest this cash inflows at the cost of capital which is given to you. Suppose the reinvestment rate is given to you as 8%. Then please tell me this 1 lakh rupees will be reinvested for how many number of remaining years, beta? 3 years. Because that project life is 4 years and the first cash inflow which you are receiving is at the end of the first year. Then can I say that we can reinvest that for the remaining period of how many number of years? 3 years. So when we are reinvesting that for the period of 3 years, can I say that this 1 lakh will now be taken 1 plus 0.08 raised to the power 3. Then again 1,50,000 which I am going to get, that I will reinvest for the remaining period of how many number of years? 2 years. So that will square it. 50,000, then I will reinvest it for 1 year. And this 70,000 is anyway received at the end of the 4th year, so there is no scope of reinvestment. Then if I calculate all these things, I'll be getting something which is called as your terminal value. What's it called as, beta? Terminal value. That is the value which you at the end of the 4th year. And once I receive terminal value at the end of the 4th year, then I have to equate it in such a way that it should be equal to your PV of CI. PV of CI and PV of CO should be the same. So suppose your PV of CO today is example 70,000 rupees. Okay. Now the terminal value example, it comes as 1,50,000 rupees. Example I'm telling. Okay. Now this 1,50,000 is, can I say, the amount which you are going to receive at the end of which year, beta? 4th year. And this is the principal which you are going to invest today. Then can I say I can use the formula amount is equal to principal into 1 plus I raised to the power n. What is the amount which I am receiving at the end of the 4th year? 1,50,000. What is the principal today? 70. And 1 plus, I want to find out the rate raised to the power 4 because there are 4 years. And based on this, then can I say I can get my modified IRR? Come on, yes or no? Yes, sir. This is the rate at which my PV of C and PV of CO both are. Okay. So these are the 7 methods. Okay. NPV lower the better or higher the better? Internal rate of return lower the better or higher the better? Higher the better because it's a rate of return. Profitability index lower the better or higher the better? Higher the better. ARR rate of return lower the better or higher the better? Higher the better. But what about payback period and discounted payback period? Lower the better. And then we have finally your this modified IRR. Are you all okay with this much part? Okay. Now my dear students, there are many questions in this particular this investment decision. Quickly go through all the important adjustments of every question. Okay. Come to question number 1. See what is given to you. Your ABC is a small company that is currently analyzing the capital expenditure proposals for the purchase of equipment, and the company uses NPV technique. The capital budget is limited to what? Rupees 5 lakhs. Everyone in one voice. If this is rupees 5 lakhs, everyone please tell me this is your money coming in or money going out. Beta, the capital budget is limited to rupees 5 lakhs. So that's why can I say this is nothing but we want to spend rupees 5 lakhs for a particular project. Come on, yes or no? Yes, this is the limit. But then this is the maximum capital it can raise. Now we will see, we have to compulsory only go for the projects which is less than 5 lakh rupees. I hope you are understanding this. The initial investment and the projected cash flows are given to you and the cost of capital is 12%. Can I say this is nothing but your discounting factor? Just check. Project A, B, C, D. Initial investment of 2 lakh, 1 lakh 90, 250 and 2 lakh 10. Everyone in one voice, please tell me, this is money coming in or money going out? So can I say this is nothing but your PV of CO? Come on, yes or no? Yes, sir. So year 1, year 2. So we have to evaluate each and every project differently. Okay. So can I say this is the PV of CO for project A? For project A, are these your cash inflows? Come on, yes or no? Yes, sir. please tell me, are the cash inflows every year different or the cash inflows every year is same? Can I use present value annuity factor for the purpose of calculation of PV of CI? Come on, yes or no? And the moment we get PV of CI, from that, what do we subtract, beta? PV of CO, to ultimately get something which is called as NPV. Here are the cash inflows same, or here the cash inflows are different? Can I say we will prepare a table, multiply that by the PV factor, get the PV of CI minus PV of CO, that will give you the final answer. Then we will select the project in which the NPV should be maximum. Then come to your question number 2. In question number 2, we are required to calculate what should be the IRR of the project. Now to calculate the IRR of the project, what do we have to do? As I have discussed, that your PV of CI should be what? Equal to your PV of CO. Can you all please tell me that in this question, what is the capital cost of the project, everyone? 3,60,000. Is this your PV of CI or PV of CO, guys? Can I say this is your PV of CO? Come on, yes or no? What is the life of the machine? What is the salvage value? And the machine will produce the net operating income after depreciation of rupees 68,000. This is the net operating income after depreciation. So can I say this is your net operating income after depreciation? So NPBDT less depreciation, it means net profit before tax. So what is the net profit before tax which is given to you, beta? 68. From this, what do you have to subtract first? Tax. What is the tax which is given to you? 45%. So can I say I'll be now getting what? Net profit after tax. To this NPAT, what will I do, beta? Add the depreciation. Will I get the cash inflows? Come on, yes or no? Yes, sir. So I'll be getting the cash inflows on per annum basis. And once I get the cash inflows on per annum basis, then what do I have to do, beta? The company's tax rate is given to you as what, beta? That is done. Then we have the net present value factors and we have the annuity factors which are given to you. Okay. Now, why the word annuity factor is given to you, boss? Okay. First of all, see, the tax is 45%. 68,000 minus 45%. What will this be? 37,400, na? And then I have to add the amount of depreciation. Can I say depreciation is original cost minus life, minus salvage divided by life? Is there any scrap given to you? So 3,60,000 divide that by 5, 72. If I add 72 to this, what will this amount be, beta? 1,09,400. Is this your cash inflow per annum? Come on, yes or no? Come on, yaar. So your PV of CI should be same as your PV of CO. If I take cash inflow per annum, multiply that by PVF, what do I get, beta? PV of CI. What is the cash inflow per annum? 1,09,400. Let this be X. And what is your PV of CI? Can I say your PV of CI and PV of CO both should be the same when we are calculating what? IRR. Can you all just check my PV of CO is what, beta? 3,60,000. If this is 3,60,000, can you guys please tell me 3,60,000 divide that by 3.29. Now just check, is the 3.29 annuity factor coming directly anywhere? No. But is it coming between 15 and 16%? Because 3.35, 3.34, 3.33, 3.29, 3.27. So Aditya, is it coming between 15 and 16%? Is it more than 15%, Aditya? Okay. And it is less than 16%. Can you tell me, beta, what's the difference between 15 and 16%? 1%. And in 1% difference, how much is the discounting I've done? 3.35 to 3.27. So that is nothing but 0. But I want to go from 3.35 to what? 3.29. So how much further discounting should be done? 0.06. This should be how much? Cross multiply. 0.75. So this is 0.75. So what is your IRR, beta? 15.7. So can I say I can also calculate IRR when the PVF is given to you in the question? Come on, yes or no? Yes. Okay. And We have to see that where this PVF is falling, and based on that we can calculate the IRR. Iram, any doubts beta? Okay. Then come to question number 3. Now see, in question number 3, what is given to you? Hey, question number 3, what is given to you? A company is considering a proposal of installing a drying equipment. The equipment will involve a cash outlay of rupees 6 lakhs. 6 lakhs, can I say this is nothing but your PV of CO? Come on, yes or no? Yes, sir. And also there is working capital requirement of 80,000. Can you all please tell me what's the total amount of investment which is supposed to be made? 6 lakh 80. When this investments will be made, beta? Tomorrow, day after tomorrow, or right now? So its present value should be what? 6 lakh 80,000. The expected life of the project is what? 5 years, and there is no salvage. And now there is depreciation based on what? Straight line basis. Income tax for income tax purpose, and then the before tax cash inflows are given to you. What is before tax cash inflows called as? Before tax cash inflows. Matlab, first of all, depreciation is subtracted or depreciation is not subtracted? Not subtracted, because it's a cash flow. And it is also before tax. So Vittal, this will be actually called as your net profit before depreciation and tax. Because depreciation is also not subtracted and tax is also not subtracted. Because it's a cash flow, na? In cash flow, how can depreciation be subtracted? So when depreciation is not subtracted and the tax is also not subtracted, then those cash flows are called as before tax cash flows, which is nothing but your NPBDT. From NPBDT, what do you subtract? First depreciation. Then what will you get, beta? NPBT. What will you subtract? What will you get, beta? Then what do? You add. Then what will you get? Cash inflows. Are you guys trying to understand this? Okay. And then, my dear students, here are we having different years? Come on, yes or no? Yes, sir. Then we will be taking every year, whatever is NPBDT, will be getting the cash inflow. And then at the end of the 5th year, don't forget, is there any salvage? Come on, yes or no? Just check, is there any salvage? No. But will there be any recovery of working capital? Come on, yes or no? Yes, sir. So then you will take here 1, 2, 3, 4, 5, 5. We'll be having the cash inflows. We'll be discounting that, and then we'll be getting what? Present value. Okay, and once we get the present value, then we can use cumulative cash inflow method to calculate what should be the discounted payback period. That's what they have asked in the first part of the question. You are required to calculate discounted payback. Then what should be the payback period? For the payback period, will I take cumulative cash inflows of present value, or will I take cumulative cash inflows for cash inflows? Cash inflows. Then we are required to calculate NPV. Can I say this is the PV of CI which you have got? From this, what will you subtract, beta? PV of CO. So we'll be getting the NPV. And then the last part is we are required to calculate IRR. We have already discounted at the rate of 12%. Then we will discount it at the rate of 15%. Then we will get a range, which one PV of CI will be greater, one PV of CI will be less. And then can I say I can use interpolation to then calculate what should be your IRR. Okay. Then there is something which is also called as capital rationing. Now capital rationing actually means your logical allocation of funds. What does capital rationing means, beta? Logical allocation of funds. And this concept should only be used, beta, when the funds available with you is less than the funds which are required. Okay. Now see, let's say for example, you only have funds of rupees 5 lakhs, but you have shortlisted 5 projects and the total of the 5 projects is coming as 7 lakhs. How much money do you have with you? But what's the total amount in all the 5 projects, beta? 7 lakhs. Is the funds available with you less than the funds required? Come on, yes or no? Yes, sir. So you know what you have to do now? You have to rank the projects. When the projects are divisible in nature, what do you have to do, beta? Rank the projects. So how will you rank the projects? You will rank the projects on the basis of profitability index, not on the basis of NPV. You will rank the projects on the basis of what? Profitability index. So you know what I will do is, I will calculate what is the profitability index for every project. A, B, C, D, E. Suppose the profitability index is coming as 1.8, 1.6, 1.9, 2 and 1.3. Now give me the rankings. What are the rankings now, beta? Can I say first rank will be D, second, third, fourth, fifth? Now what should I do is, I should first try and invest the money which I have in the first project. So the first project is what, beta? Project D. So suppose for example I have 5 lakh rupees and project A requires 2 lakh rupees. Can I invest 2 lakh rupees in project A? Come on, yes or no? Yes. So I will get full NPV of project A, of project D. Then I will invest the next amount, in the second project. Suppose second project is project C. Suppose project C just require 1 lakh rupees. Can I invest 1 lakh rupees there? Come on, yes or no? Yes, sir. Suppose third rank is project A. Now project A requires, example, 6 lakhs or whatever, it requires 4 lakhs, but I don't have that much amount available. So now when the projects are divisible in nature, can I partially invest in this project? Come on, yes or no? Yes, sir. And when you invest partially in that particular project, so whatever balance amount is left, you invest in that particular project. Will you get the full NPV or will you get the partial NPV, beta? Partial NPV. And then you will make the total of all these things, and that's the total NPV which you are going to get. And guys, when the projects are indivisible in nature, what did I just say? When the projects are indivisible. When the projects are indivisible, then partial investments are not possible. So what you have to do is, whatever amount you have now, you will try to create various combinations of that. So for example, you have 5 lakh rupees. Then you will first see what is the combination of A and B. Suppose combination of A and B comes to 4 lakh rupees. Okay, cash outflow 4 lakh rupees. So can I say 4 lakh rupees is less than 5 lakhs? Come on, yes or no? Yes, sir. So we will invest 4 lakh rupees in A and B and check what is the NPV. Then you will try to make combination of B and C. Then you will make the combination of A and D. Matlab different combinations you will make within your limit of 5 lakh rupees. And then we will select the project in which the NPV is going to be maximum. But that is only to be done when the projects are dash in nature, indivisible in nature. When the projects are divisible in nature, at that time, can I say partial investments are possible? So we can use profitability index concept. Okay. Then this is also the same concept. Okay. Now, my dear students, there is a concept of replacement decision in capital budgeting. What is it? Replacement. Now, what do I mean by replacement decision? See, beta, in replacement decision, they will always give you that you already have an existing machine and you want to replace the existing machine with the new machine. Can I say only the replacement is possible when the new machine provides higher benefits as compared to the existing machine? Come on, yes or no? Yes, sir. So see, whenever there is replacement of machine given to you in the question, always approach incremental NPV. What did I just say, beta? Incremental NPV. What is incremental NPV? Incremental PV of CI. From this, what do you subtract, beta? Incremental PV of CO. What do you ultimately get, beta? Incremental net present value. I'll explain you with the help of an example. Suppose Aditya got a job in Chennai and for example, he's getting a package of 6 lakh rupees per annum year. Now he gets an offer from Mumbai and Mumbai people are offering him 10 lakh rupees per annum. What is the incremental cash inflow he's getting? 4 lakhs. But don't you think there is going to be incremental cost also? So suppose incremental cost comes as 5 lakh rupees. Then what do you think? He should replace his job, yes or no? No, because there is a negative. So similarly, suppose whenever you are buying a new machine, of course you have to spend on the original investment. Then you will be subtracting whatever is the salvage of the old machine which you are going to get. This will give you incremental cash outflow. Then we will see that what is the cash inflow generated by old machine, what is the cash inflow generated by new machine. Suppose cash inflow generated by old machine is 1 lakh. Cash inflow generated by new machine is 1,50,000. So what's the difference between the two? 50,000. So this 50,000 is called as my incremental cash inflow. Come on, yes or no? Yes, sir. And suppose this is every year same, then can I say I can multiply that by the present value annuity factor? And can I get the PV of CI? Come on, yes or no? Yes, sir. And if this incremental PV of CI is greater than the incremental PV of CO, then should you replace the old machine with the new one? Come on, yes or no? Yes, sir. You should do. Okay. So in incremental NPV, what will we do, beta? We will take incremental PV of CI and we will subtract incremental PV of CO to get the incremental NPV. In this particular question, see, HMR is considering replacing a manually operated old machine with a fully automated new machine. Can I say this is the question on replacement? Come on, yes or no? Yes, sir. The old machine has been fully depreciated for tax purpose, but still has a book value of 2,40,000. My simple question to you is, when a particular machine is fully depreciated for tax purpose, will income tax allow any further depreciation? No. There is no depreciation benefit which is available for the old machine. The machine has begun causing problems and it cannot fetch more than 30,000 if sold in the market at present. If you want to sell it in the market, you are just going to get 30,000. And anyway, it is not going to have any realizable value after 10 years. But the company has been offered 1 lakh for the old machine. Now tell me one thing. The old machine in the market, if it is sold, you are just going to get 30,000. But if you are purchasing the new machine, then you will be getting an exchange value of 1 lakh. What should you do with the old machine? Sell it in the market or exchange it? Exchange it. And now, what is the cost of the new machine? 4,50,000. The cost of the new machine is 4,50,000. But how much are you going to get as an exchange for the old machine? 1 lakh. So how much extra will be paid from your pocket, beta? Can I say 3,50,000 will be paid today itself? Come on, yes or no? Yes, sir. That needs to be multiplied by 1. Will this give you incremental PV of CO? Come on, yes or no? Yes, sir. And then the company follows straight line method, but for tax purpose, we have to follow WDV method. Now, when there is WDV method, it means that every year the depreciation is going to be same or every year depreciation will be different, beta. Different. So they have given you sales less material cost, labor cost, variable overhead, fixed overhead, depreciation, PBT less tax, NPAT. Now see, do you have the PBT available? Come on, yes or no? Yes, sir. Now NPBDT less depreciation gives you what? NPBT. Can you give me old machine NPBT, beta? What is old machine NPBT? 3,24,750. This is the old machine NPBT, na yaar? 3,24,750. What is the new machine NPBT, beta? 3,87,250. What is the amount of depreciation, beta? 24 and 41,500. 24 and 41,500. Can I get the NPBDT between old and new machine? Come on, yes or no? Yes, sir. Can I say that is 324,750 plus 24,000? How much is this, beta? 348,750 and 387,250 plus 41,500. This is what, beta? 4,28,750. Can you all please answer this in one voice and tell me, are we earning some extra NPBDT? Come on, yes or no? Yes, sir. What is the extra NPBDT I am earning? The extra NPBDT I am earning is 428,750 minus 348,750. Can I say the extra NPBDT I am earning is 80,000? Come on, yaar. And that I will earn for how many? 5 years. How much they have to do? 10 years, na? So we will be calculating that for the period of 10 years. So how much extra you are earning? 80,000. But now the depreciation every year will be the same or depreciation every year will be different, beta? Different. Now my one very simple question to you is, will you calculate the depreciation which is 7.5% rate on 4,50,000 or will you calculate that on 3,50,000, beta? 3,50,000 because 4,50,000 is the cost, but you have already got 1 lakh rupees. So then your net cost of the asset is what, beta? 3,50,000. And in old machine, so anyway, you are not getting any depreciation. So will that 3,50,000 be multiplied by 7.5% and will the depreciation be calculated? Come on, yes or no? Yes, sir. That basis will be getting PV of CI minus PV of CO, you'll be getting NPV. So this was your incremental method. Okay. Question number 7 is a very simple question pertaining to your calculation of NPV. So this question is, I'll give you a gist. It's a question on decision making. What is happening in particular company? This is in this particular company, in this Manoranjan Limited question. All these questions you'll find in study module. In this Manoranjan Limited question, now what is happening is The company has 200 employees. Okay. And the company is at present, you know what they are doing? At present, the company is giving tea and coffee to their employees by outsourcing to someone. Matlab, someone is coming from outside and they are giving tea and coffee. So of course they are spending some cost there. Come on, yes or no? Yes, sir. Now what is happening is that the company is thinking that rather than spending somewhere outside, you know what we should do is we should have our own tea and coffee vending machine. Now do you think that own tea and coffee vending machine will be free of cost? So is there a PV of CO which will come there? Come on, yes or no? Yes, sir. There is present value of cash outflow. But also at the same time, now all the ingredients, etc., all those things is going to be your cost. Come on, yes or no? Yes, sir. So here you have to apply a little bit of costing concepts and find out that what is going to be the cost here. It means, for example, 10 grams of sugar is required for 1 cup. If this much cups will be required, then how much grams of sugar will be there? So how much packets of sugar will be taken into consideration? So based on that, you will be getting different types of material cost, then supervision cost, cup ka cost, consumption cost, and all those things we have to take into consideration. And then we have to see that how much was the savings which was happening. Suppose I am spending, example, 5 lakh rupees today, you know, for paying to the outside vendor for supplying tea and coffee. I'm spending how much? 5 lakhs. If I have my own tea and coffee machine, immediately I'll be saving that 5 lakhs. Come on, yaar. That much amount I don't have to pay, na? So any outflow avoided is nothing but the cash inflow. Come on, yes or no? Yes, sir. So that much amount will be saved. Now when that much amount will be saved, from that we have to also subtract what is the cost of ingredients. And when all those things will be subtract, we'll be getting the net profit before depreciation tax. We'll be subtracting depreciation, we'll be getting NPBT. Subtract tax, we'll get the NPAT. Add depreciation, cash inflow. We'll discount it and we'll bring it to the present value. Then we will see that what is beneficial. We'll calculate the NPV and we'll see whether we should buy our own vending machine or whether we should continue with the outsourcing part. Okay? So this is the gist of the question. It's a decision making. Okay. Next, there is nothing new in this particular concept until unless you just have to, take into consideration all the different cash outflows and cash inflows. That's it. Now, question number 8, in this particular question, you know what is happening? There is a particular company, okay? And this particular company is generating some waste, okay? And at present, you know what is happening? That whether we should sell, whether we should dispose this waste or whether we should convert it into a new product. That is the summary of this particular question. What should be done with beta? Whether we should dispose the waste or whether we should convert the waste into new product. Okay. Matlab, many times this happens that there is some chemical company, it is generating some waste. Now, this chemical waste, we cannot dispose it off on normal roads. Na? So we appoint some contractor. And what is the use of that? What will the contractor do, beta? This contractor will take the waste and dispose it off at safe places. Will it do it for us free of cost? Of course not. So can I say, is he going to charge you with something? Come on, yes or no? Yes, sir. So suppose he is charging you 50 lakh rupees per year. The moment you decide that I don't want the waste to be disposed of, I want this waste to be processed further, what do you think will happen to the 50 lakh rupees, beta? Can I say you will be saving that 50 lakh rupees? Come on, yes or no? And any savings in capital budgeting, will it be treated as cash outflow or cash inflow? Cash inflow. But then when you want to manufacture this waste and make it into a new product, can I put it like this? When you want to make it into a new product, for that we will require machinery. And that machinery is going to cost you something. Come on, yes or no? Yes, sir. So that will be a cash outflow. Again, now there will be some raw materials cost, etc. All those things will be, which will be levied. And also when that new product will be made, what will you do? We will sell it in the open market. So there will be some selling price, etc., which will also be given. So we have to calculate what should be the cash inflow which will be generated if I am going to, Shriram, I am going to just check that whatever is the cash inflow that will be generated because of sale of that particular new product. And then I will compare that with whatever is your cost of the machine. Can I say if suppose the PV of CI is greater than the PV of CO, should we dispose the waste further? Come on, yes or no? Yes, sir. And if suppose your PV of CI is less than PV of CO, then we will not dispose the waste. Always remember that in investment decisions, any kind of outflow avoided is nothing but your savings. And that savings should be forming part of your cash inflows. Come on, yes or no? Yes, sir. Now read this particular question. A chemical company is presently paying an outside firm ₹1 per gallon to dispose of the waste resulting from the manufacturing operations. At normal capacity, the waste is about 50,000 gallons per year. Everyone in one voice, please tell me, what is going to be the total amount which you are going to pay to the contractor every year to dispose of the waste? 50,000 rupees per year I am paying. Come on, yes or no? Yes, sir. After spending 60,000 on research, beta, whenever you pay anything on research, na, it's already a historical cost. Will it continue further? Come on, yes or no? Then the answer is no. Matlab, will it come in your decision making? Yes or no? No. Any kind of historical cost is already paid. That is not going to now impact the decision making. Okay. So historical cost, will it come in capital budgeting decisions or it will not come in capital budgeting decisions? It is not going to come in capital budgeting. So 60,000 research expenses has already been done. Will it come in your decision making or you have to ignore this beta? Ignore. Okay. See, at the end now I'll give you a note that there are 3 types of costs which are ignored in capital budgeting. One is this historical cost. You can write down now also if you want. One is what? Historical cost. That is something which is avoided. Okay, historical cost will not come in your capital budgeting because it's already paid before. So it is not going to come in your decision making. Okay. Historical cost, consider or ignore beta? Ignore. The second type of the cost is which we are not going to consider is called as allocation of expense. Allocation or apportionment of expenses. It is called as apportionment. So allocation or apportionment of expenses, we ignore it. And the third type is called as irrelevant cost. Irrelevant cost also we ignore it. Why irrelevant cost we ignore it? Because that cost we have to pay anyway, whether I buy this product or I manufacture this product or this product. So that is irrelevant cost. Now suppose I want to buy a car. Okay. So I have 2 types of cars in my mind, whether I should buy car A or car B. Okay. Now, one second. What type of cost I told you? Historical cost, allocation or apportionment of cost, and Pankaj, irrelevant cost. Irrelevant. When I'm buying a car, please tell me that which driver salary an important part? Decide. No, why? Because driver salary is anyway not required only. Hello? Because driver salary is something which I have to pay whether I buy car A or car B. But yes, is the mileage an important part which should be used? Yes, sir. So all these things are to be taken into consideration. But irrelevant cost, we have to ignore it. This 60,000 is your historical cost. Will you consider it or will you ignore it, beta? Ignore it. Then the waste can be sold at what? ₹10 per gallon. So is there any sales which is available? Come on, yes or no? Yes, sir. And it would require an investment of ₹6 lakh in the new equipment. Can I say this is nothing but PV of CO? And the life is 10 years with no salvage. Depreciation is SLM. Then there is some advertisement expenses which is 20,000. And there is variable cost of ₹5 and fixed cost is 30. So if I prepare the income statement, sales minus variable cost minus fixed cost minus advertisement expenses. Can I say my sales will be 50,000 gallons I'm going to sell at ₹10 per unit. So 5 lakh will be the sale. Come on, yes or no? Yes, sir. What is variable cost? Beta, variable cost is ₹5 per gallon. So 2,50,000 will be your variable cost. Is there any fixed cost? Come on, yes or no? Yes, sir, 30,000. Is there any advertisement cost? Come on, yes or no? Yes, sir, 20,000. So can I say this will now give me my NPBDT? Okay, and this NPBDT is how much, beta? 2 lakhs. From this, what will I subtract? Depreciation. What will I get? NPBT. But wait, I am also having some kind of savings. Any savings is nothing but one type of a cash inflow, no? So savings should be added or subtracted, beta? Added. Because my profits have increased by 50,000 because now I am not appointed that contractor to dispose of the waste. So don't you think that that is one type of savings? So savings needs to be added to my profits, yes or no? Yes, sir. Then I'll be getting my adjusted NPBT. From this, what will I subtract? Tax. Can I say I'll be getting NPAT? Add the depreciation, I'll be getting cash in. And then we'll be discounting that and bringing it to present value. So this question was based on whether you want to dispose the waste or you want to continue it further. Okay. Then this question is on optimum replacement time. Now, always remember that every machine, has a particular time on which the replacement should be done. See, you are aware about the fact that, let's say for example, you buy a car today. Now, car can be used for 15 years also. But if you use the car for 15 years, then what are the consequences? Can I say that if you use the car for 15 years, then maintenance cost will be increased year after year? Salvage value will be reduced year after year. So there has to be one time now where you should replace the car which gives you maximum benefit. So this question is on optimum replacement time. So what you need to do here is now you have to calculate what should be the net cash outflow per annum. Now remember like this, that if suppose you want to invest in two projects, project A, project B. Suppose project A has a life of 5 years, project B has a life of 7 years. Can you compare directly the NPV between the two projects? Then the answer is no. Why? Because one project has the life of what? 5. One project has the life of what? 7. So don't you think that the NPV cannot be directly compared? So we have to calculate NPV per annum. Whenever the project lives are different, what do you calculate, beta? NPV per annum. How do you calculate NPV per annum? You take the NPV and you divide that by present value annuity factor. That gives you NPV per annum. For the timing, just remember this, that whenever project lives are different, what do you have to do, beta? You have to calculate your NPV per annum. And what is NPV per annum, beta? You take the NPV and you divide that by the present value annuity factor. Will that give you NPV per annum? Come on, yes or no? Yes, sir. Now in this particular question, what is happening is that you have to calculate what are the different types of cash outflows which will be generated if you replace the machine at year 0 or at year 1 end or at year 2 end or at year 3 end. Can I put it like this? We should replace the machine in the year in which the net cash outflow per annum should be maximum or it should be minimum, beta? It should be minimum, where the net cash outflow per annum is minimum. It's not necessary that you should use the machine for full 4 years. Because in full 4 years, can you see the maintenance cost is at the peak and you are not generating any salvage also. So we should replace the machine somewhere in between in a way that your NCO per annum is going to be least. Okay. The institute has solved this question in 2 ways. Both the methods are very nice. You can just see the solution in one of the way which is convenient to you. You can calculate NCO for each and every method. For each and every year on per annum basis and replace the year in which the machine, the NCO per annum is the least. This question is on optimum replacement time. Then we have this 10th question. Now in this 10th question, what is the case? There is one particular hospital. You know what happens in hospital, that when you go, for example, if you have a disease and if you go and you consult a doctor, then the doctor will tell you that, listen, you have to do these all tests. So when you have to do all these tests now, then he will also tell you that this doesn't happen in my hospital example. You have to go to this laboratory and do the test. Now you must be feeling very good here. It's so nice that the doctor is recommending such kind of a lab. But I hope you all know that the doctor is going to get some dash. Can I say commission based on this particular lab? Come on, yes or no? Yes, sir. The doctor is going to get some commission. Okay. Now the hospital thinks that instead of transferring the patients there, let us have our own diagnostic machine and let us have our own diagnostic center so that the patients don't have to go anywhere else. Now this is not a free work. Are they going to charge from the patients for any diagnosis they do? Come on, yes or no? Yes, sir. In this particular, each and every question has its own art here. Okay? So if you refer to all these questions, all these concepts will be covered. Now, what is happening in this particular question is, and you will find this in your study modules also. Now, in this particular question, you know what is happening? That if suppose I am having my own diagnostic center, if the patients come, then can I say I will charge them some revenue? Come on, yes or no? Yes, sir. There is cost of operating machine, so which I'll subtract. Again, NPV concept. From sales, you will be subtracting whatever is the cost, etc., depreciation, and PAT, etc. You will be getting the cash inflow. But don't you think that that commission income which you are receiving from there, will you continue to receive or you will not receive it? If you will not receive it, then can I say this is inflow avoided? Come on, yaar. You will not receive that commission income. Arey Baba, if you are spending somewhere and you stop spending it, then can I say it's treated as your inflow. Similarly, if you are supposed to receive any inflow, but now you have stopped receiving that inflow, then can I say you can treat that as an outflow? Come on, yes or no? Of course, yes. So the commission income which you are receiving, now you are not receiving, can I say it will be treated as an opportunity cost? And what to do with the opportunity cost, beta? Should you add it or should you subtract it? Subtract it. And the best part is they have told you that they are earning the commission income of 36,000 per annum net of taxes. Now, when I tell you it is net of taxes, it means that this commission income which should be subtracted, should it be subtracted before tax or it should be subtracted after tax? Then the answer is after tax it should. And then we will calculate the NPV and see whether the diagnostic purchased. Then question number 11, you can completely ignore it because we have done that particular question. So that basis you will be okay. Now see, this question is also about replacement question. Can you see there is existing machine and there is new machine, beta? Again, the concept remains the same in replacement. What happens in replacement, beta? Can I say the old machine needs to be replaced with what? New machine. So we have to first see what is the cost of the new machine, how much are we getting for the old machine, and that will give you PV of CO. Then we will calculate the net profits before depreciation tax for both the machines, and then we will see in which particular machine your new machine is giving you how much incremental cash inflow. We will discount it and we will bring it to what? Present value terms, and that's how you'll be getting the answer. Okay. So this particular question is also based on what, beta? Replacement. Based on your replacement decision. Okay. And then that's it. So this was the last question of your investment. Have you all understood this particular thing? Okay, what you have to do? Okay, everyone understood NCO method, NPV method, NPV per annum, replacement decision, what types of cost needs to be ignored, IRR, PI, everything I have discussed. Okay. But you just have to solve this question based on the gist which I have just told. Okay. So if this much you will solve now, these 10 questions, one question I have omitted, and one, it's very easy, that NPV and AI and profitability index. If that much, if you do it, then your investment decision, all the concepts will be, because if you can see, I have covered the concept of opportunity cost also, and I've also covered the concept of savings also. All these things. Okay. Now, one second. Before we continue, before we wind up, do you know there is this cost of capital 2 which I told you that is pending? That is YTM. Now, what happens in this YTM is, in cost of capital, na, what you have done? That pencil. Very good. What's your good name? Salam. Salam has a very special art. The pencil in the beard. Managed it without. I am teaching investment decisions. Okay. But that is not important. What is important, that somehow manage to, hang the pencil or something, and then he was able to balance. But very good skill, beta. But unfortunately it doesn't come. Okay. But how did you do it? You have practiced a lot, right? Beta, y'all can practice this, okay? Aditya, you can't try because there is no beard. Okay. Gauni. All these things are important. But people are doing different skills here. How to balance pencil. Acha, now YTM. YTM, why I've left it for last is because YTM is very similar to your IRR. YTM is very similar to your IRR. What is IRR beta? Can I say IRR is the rate at which your PV of CI is equal to PV of C. Okay. Now in your YTM, you know what happens is, for example, there is a particular debenture with a face value of 100. The coupon rate is example 10% and the life is example 5 years. The redemption value is 105 and the issue price is, let's say, 100 rupees. Okay. And there is a flotation cost, Salam, and the flotation cost is 4%. Okay. Can you all please tell me, beta, if the tax rate is given to you as 30%, if I tell you how to calculate KD, you know how to calculate KD, beta, KD? How will you calculate KD? KD is equal to what? Interest. Can I say 100 ka 10% is 10 into 1 minus tax plus what is the redemption value? 105. And this is 100 minus what's your flotation cost is 4%, so 96. Life 5 years. And I will take this 105 plus 96 upon 2. Okay, Salam. Now, will this give me the KD? Come on, yes or no? Yes, sir. What will be the KD, beta? 7 plus 105 minus 96 divided by 5, 1.8. Divide that by 105 plus 96 divided by 2. That is 100.5 to 100. So can I say this is 8.8? Come on, yaar. Divide by this into 100. So this should be 8.76. This is one of the way to calculate the KD which you all know. But whenever they ask you now that you are required to calculate the KD using YTM method, then you know what you have to do? You have to apply the concept of IRR. Can you please tell me here what is the issue price? What's the flotation cost? 4 rupees or 4%. So can I say 96? 96. Can I say the company is going to get 96 rupees? Come on, yes or no? Yes, sir. Or else think from the investor's perspective. An investor is going to purchase at 104% flotation cost. Matlab, understand like this, that 96 rupees is your PV of CO. Understand like this. What is 96 rupees, beta? PV of CO. Now, my dear students, you are required to calculate the rate at which PV of CI will be equal to PV of CO. Now, please tell me that how many years are there? 5 years. Okay. Now, can I say that for 5 years there will be interest and there is going to be redemption value? What is the amount of the interest, guys? Can I say on 100 the face 10 rupees? So can I say 10? But that is subject to the tax of 30%. So can I say 77777? This will be the interest. And at the end of the 5th year, what will be the redemption value? 105. So in YTM, you have to do nothing, but you have to prepare a range at which the PV year is equal to 96. Are you understanding this? YTM is nothing more, but it's nothing but your IRR. Just have to simply take whatever are your cash inflows like this 7777 and then 105, and then we have to discount it in such a way that it becomes equal to what, beta? 96. So here also I am going to discount. So I'll take a range of 5 and 10%. And can I say I'll be getting the PV of PV under both the scenarios? Come on, yes or no? Yes, sir. One will be greater than 96, one will be less than 96. And then can I say I can do 5% plus interpolation, get the YTM? Come on, yes or no? Yes, sir. I wanted to practice this YTM well. With this, my dear students, now I can say that the entire revision is now over. I hope you all have understood, enjoyed, and I've tried to cover maximum concepts as possible, you know, and there is so much which actually needs to be done, but in this revision I've tried to cover every chapter, not even left a single chapter, and also we have covered from every chapter every concept as well. Please make it a point that now you practice all those things and you are able to do it. Okay. So minimum how much do you have to get beta? 50. Minimum beta. 49 is maximum I can allow you. Okay. Now regarding your MCQs part, na, I will tell you that in the month of December I'll be putting some MCQs as my Instagram story. Please do before the attempt. Okay, you all can just attempt there, and also there will be on app as well. Okay, you have the app and you can do it there as well. In content, there will you will also see. Right now, it's not published. The first week of December, it will be done. So then you can solve the MCQ for every chapter, which will be there. That is available free for all the students. You all can just solve it on your own. My advice is, first what you should do is you should your chapter, okay, from whatever notes you all are studying, complete that chapter on your own. Then refer to the study module and do the differential question, because there is a possibility that that notes may or may not cover. So do the differential question. Once that is done now for a chapter, then the next thing what you have to do is you will have to then take into consideration your case study and MCQ chapter wise, which I will be uploading. Chapter wise case study and MCQs, if you'll be doing, then I'm very sure that I'll not put more 5 to 6 MCQs per chapter, because it's not required also to put more. One case MCQs. Also do ICI MCQ. ICI MCQs are also there, right? So this much if you're able to do now, then your one chapter will be over. Okay. And then do second chapter same. Revise from your classes. No. Okay. Just put tick mark or whatever you do. Just solve couple of questions for having that hold. Okay. And then after you complete that chapter, go through the study module, see the differential questions. If you're able to crack or not. Once that is also done, then what you have to do? MCQ. Case study MCQ. And the moment you do chapter wise, na, then towards the end, everything will be complete. Okay. RTP's videos will also be coming on my YouTube, so that will also uploaded. Not getting time. Moment that is done, so RTP will also be for FM. So don't worry about that. If suggested answer comes for 24 very soon, then that will also be uploaded. That as well. Okay. And it will not be more for 1.5 hours or something like that. You go through it once, quick speed, please do. Okay. And just listen to me, something like that. Okay. Go through the concepts and that basis it. Okay. This much I wanted to tell you guys. It was lovely teaching you all, and it was a very nice experience. God bless you all. And be updated with your results as well. Okay. And I'm very, 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 very happy. All in this 2 days really passed very fast. Okay. At least in my case, I don't know about you guys. Okay. And I have met different people, different talents also. Okay. Were very nice. Okay. So that's it, my dear students. We'll put an end for today's lecture here. Bye guys. Take care. See you. Bye. Bye guys. All the best. Bye. 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 You're always welcome. Thank you. Bye. Thank you. Thank you, online students. Bye guys. Take care. Thank you.